Uh, so hi there. It's a Saturday, the weekend's here, and I thought of doing a video on mutual funds and just wanted to cover very basic aspects of investing in a mutual fund, since it's a great way and probably the best way for first-time investors to take equity exposure. And there are a lot of aspects when it comes to investing in mutual funds. I've tried to cover most of them. I've tried to make it as simple as possible. In case of any questions or any clarifications further required, you could just comment it down, and I'd be happy to answer them. So, just want to get started, and this is a topic which has always interested me. Mutual funds have been a great creator of wealth in the past, and they will continue to do so in the future as well. And there are a lot of questions that investors have, especially first time investors have, when it comes to mutual funds. Now, what what's the issue that we exactly face? So when you were to if you were to go to any website online like ET Money or Grow, and you just search mutual funds, I think you'll end up with around hundreds of suggestions. A lot of different asset management companies exist in India, which there are around 44 asset management companies. So these are your HDFC Mutual Fund or ICICI Prudential Mutual Fund. There are 44 companies that exist. Each company has hundreds of schemes, and it becomes really difficult for any investor when they're in the markets for the first time to decide which of the funds to buy. And further, what happens is there are different categories of mutual funds that exist. You have equity funds, you have debt market funds, you have hybrid funds which sort of have both equity and debt in their portfolio. And within a given category as well, there are so many subcategories that exist. So for instance, if you were to pick equity funds as a category, within that you'll have large cap funds, you'll have small cap funds, you'll have flexi cap funds. So the problem just compounds for an investor. So here's an investor who's coming to the markets for the first time, and the moment he or she opens up any of the mutual fund related pages, they're swarmed with choices. And naturally, when you have so many choices available in front of you, it becomes difficult to make a decision. Now, for instance, when it comes to debt funds as well, within debt funds, there's credit risk fund, there are liquid funds, there are sovereign funds. So there are just too many products, there's just too much noise, and investors need to find out a way to cut down this noise. So, so before you even begin this whole journey of deciding which mutual fund to buy, I think it's important to ask yourself these three questions. That is, what is my goal? So basically, why are you why are you into buying mutual funds? Do you want to plan for retirement? Do you want to save money for taking your next vacation? Do you want to save the money for your further studies? Do you want to save money for buying a car or a home? You need to define your goal, because based on the goal, your time horizon will also vary. So for instance, if you're planning to pursue further studies down the line, essentially you're making your time horizon sort of shrinks down to say 5 years or 4 years from now. And as your time horizon becomes lesser, your risk taking appetite will also fall. Or rather, as your time horizon falls, it's prudent to choose products that have guaranteed returns and where the risk element is pretty minimal. So, let me give you a scenario. So, say you're planning to do your master's 3 years from now, for which you're saving up your money. Now, you might decide to buy 100% of your money into equity funds. Now, there are two scenarios that could take place. Equity markets do extremely well, and the amount of money that you have invested grows to a very large corpus in the next 3 to 4 years. This is a very good scenario. On the other hand, what might also happen is, for the first 2.5 years, your portfolio does extremely well. Then, for some reason, in the last 6 months, there's a massive correction in the market, and your investments say fall by 30 to 40%. Now, in such cases, a large part of your capital is wiped out because of unforeseen market events. And 3 years down the line, when you actually need the money, you'll notice that a large part of your capital is actually gone. So that's why, in such situations, when you know that you require the money after a fixed time horizon, it's better to stick to products that guarantee your returns and at the same time have a lower element of risk. On the other hand, if you are planning for retirement and your retirement is say 15 or 20 years down the line, in that case you could increase your exposure to risky assets like equity. So defining your time horizon is probably one of the most important decisions that you'll ever take. And most people are unable to get the first two parts right. So people might end up having their goal as, say, they want to buy a house 5 or 6 years down the line, and they might put all their money in equity investments, and when they actually need the money, the market may fall, as a result of which a large part of the capital is actually wiped out. The third question is also is a very individual specific answer that you'll have. Where exactly are you in your earning cycle? So this would probably require you to ask yourself, have I just started earning my paycheck? Do I have any dependents in my family? And do I want to take early retirement, or do I want to, explore some entrepreneurial venture sometime later? So the answers to these three questions determine what sort of mutual funds you buy and for how long you hold it. And it's very important to ask yourself these three questions. And this is the first thing that you should do even before logging into Zerodha or Grow or Upstocks or whatever platform you might use to buy your mutual funds. So in most situations, investors just don't ask themselves these three questions, and they blindly put their money into random mutual fund schemes, which makes your entire investing process highly unsystematic. There's no method to the madness, and there are suboptimal returns as a result. So just answer these three questions. If you're unclear about the answers to these three questions, you can consult a financial advisor, or you could talk to someone who's pretty aware of mutual funds and how various products behave in a given time horizon. Now, typically for an asset class like equity, it takes some time for the returns to be seen. So, if your time horizon is greater than 5 to 6 years, equity becomes a great product. Even within debt market funds, uh, based on the time duration, the returns will vary. So, for instance, if you go to a bank and you make a fixed deposit, you'll notice that as the tenure of the fixed deposit increases, the interest rate on that fixed deposit will also increase. So, just make sure that you've asked yourself these three questions and you've answered it satisfactorily. Now, moving on. Yeah, I mean, as I said, things you should not do. Um, uh, these are the things that you should just avoid. So I see people buying mutual funds that have performed extremely well in the past. So it could be something as simple as this. You just log into your Zerodha or Grow. You choose a particular mutual fund that has done that has given very good returns in the last 3 years or last 1 year, and they just end up buying that, thinking that the returns that have been realized in the past will be realized in the future as well. But equity markets and financial markets are forward looking. So anything that has happened in the past should not really influence your decision to invest. And The other mistake that I see many people do is they simply buy too many mutual fund schemes, thinking that the more number of schemes that they buy, the more diversification they're doing. While in reality, what happens is like many of the mutual fund schemes have very similar portfolios. Now, even before like delving into the second point in greater depth, let's just understand what a mutual fund does. So, what a mutual fund does is it takes money from many different individual investors and they buy a portfolio of stocks with that money. So what happens is they take, say, there are 1,000 investors in a particular mutual fund scheme. Each investor has given 100 rupees to the mutual fund company. Now, with this 1 lakh rupees, which is 1,000 into 100, this money is split into various different stocks, or they might decide to invest that money in government securities, government deposits, or they might even put that money into fixed deposits, for instance. Now, what's the advantage of a mutual fund? So typically, what happens is if you were to consider the equity markets, take for example, you want to buy three stocks: HDFC Bank, Reliance Industries, and Infosys. Now, one stock of Reliance is worth 2,000 rupees, one stock of Infosys is worth 1,600 rupees, and one stock of HDFC Bank is worth 1,500 rupees. Now, if you're a first time investor who has very limited capital, it's difficult for you to buy different stocks with that limited amount of money. You might just have 2,000 rupees in your bank account, and in such a situation, you will be able to buy just one stock of Reliance because you're not allowed to buy partial amount of shares. But the advantage with mutual funds is since there's a larger capital pool available, you get exposure to various different stocks with limited amount of money. So today, most mutual fund schemes have a minimum investment of 1,000 rupees, and the underlying portfolio will consist of around 40 to 50 stocks. So in a sense, with very limited amount of money, you're able to spread your risks across 40 to 50 companies, and at the same time you're able to take the benefits of the returns that these 40 to 50 companies are going to make for you. So when you have limited amount of capital, it makes perfect sense to stick to mutual funds for your equity exposure. So what happens is, in many cases, if you consider an equity mutual fund, it is highly likely that the scheme offered by one mutual fund house would have very similar stocks as the scheme that is suggested by some other company as well. So if you just blindly end up buying too many mutual fund schemes, chances are that there would be an overlap of stocks in your portfolio. The third point, slightly controversial, index funds has been really fashionable. Index funds have been really popular over the past few years, especially post COVID, as people started entering into the equity markets. I'm pretty sure most of you would have put some of your money into index funds. While I'm not 100% against index funds, I have my reservations against them. And in my opinion, putting 100% of your money into index funds is also not the best idea. There are a lot of reasons for it, which I'll be covering in some session later on. But as a starter or as a starting point, it would be prudent to not put all of your money into index funds. You could probably have some part of it into index funds, and you can consider buying some actively managed schemes as well. Now, as I mentioned a while ago, a mutual fund collects some amount of money from different individual investors. Now, in order to run their day-to-day operations, mutual funds sort of deduct a part of your investment as expense ratio, and this expense ratio is kind of calculated as part. The expense ratio is typically a certain percentage of the investment that you're making. So, for instance, if you're investing 1,000 rupees and the expense ratio of that scheme is 2%, around 20 rupees would be deducted and the rest would be invested in the market. But this does not mean that the 20 rupees of expense is deducted on the first day itself. It is spread out over an entire year, and based on the closing value of your portfolio, that expense is deducted. Now, I wouldn't get into the technicalities of calculating the expense for a particular portfolio, but all you can keep in mind is whenever you're investing in a mutual fund, some part of your returns will go away as expense ratio to the fund house. Now, as I mentioned, mutual fund or a particular mutual fund would be managed by someone, right? There'll be a fund manager who will decide which stock do I buy with the money that the investors have given him or her. Now, you need to understand the mind of a fund manager. After all, you're sort of entrusting your savings with that one person, right? So, you need to understand how a typical fund manager always thinks. Now, a typical fund manager would always be bullish. And the reason for this is, they sell this story that just keep buying, keep investing regularly, keep investing consistently. So, if investors are investing consistently, it means more inflows to that fund house and they're able to make more money by taking that expense ratio. So, they'll always be bullish. Uh, you know, in the stock markets, you shouldn't be a bull or a bear. You should be, a realist. You should just look at what the underlying economic scenario is and make your decision, you know. You can't live in a delusional world if you're an investor. Just because you've made some equity investment, you can't expect that equity markets will always keep rising. You need to be a realist. Most fund managers sell you the story that keep investing consistently, keep investing regularly. While I completely agree to their facts, I completely agree that you have to invest regularly, but it's not necessary that all those investments have to be in equity markets. So, and each fund manager is sort of influenced by certain principles. So, for instance, certain fund managers might say that I'll buy stocks that are having a low price to earnings ratio. Certain fund managers, might say that I'll buy stocks belonging to this particular sector only. Certain fund manager might, say that if a particular company has these characteristics, say if the company does not have a track record of last 10 years or 15 years, I won't invest in them. So each mutual fund manager has his or her principles, and and this principle is reflected in the portfolio of the funds that they manage. Now, that would be a very in depth analysis that any investor would have to do. But in the subsequent sessions, I'll be covering how do analyze portfolios of different individual mutual funds, and how do you sort of find out if the fund manager is actually practicing what he or she is preaching. And that is one of the most important criteria that you need to use. And then you need to see how these fund managers have performed in past cycles. And most notably, you need to see how a particular fund manager behaved in the last down cycle. If so, a typical investor would sort of panic and exit their investments when the market falls. But a mutual fund manager, by definition, is someone who's got enough experience in the market to know that a market downfall is not the time to exit a stock, but rather buy more of that stock. So these are the kind of filters that you need to uh, put, and you need to critically analyze what the fund manager managing your money has done in the past. And I'm pretty sure this is a new way, or this is a different way of thinking about your mutual fund investments. I do concede that the answers to these three questions would take a lot of time for you to find out. It would take a lot of effort to go through multiple Excel sheets that the mutual fund house will share with you. But it's worth the effort, because ultimately you're entrusting your savings to the mutual fund manager, and you want to make sure that things go as planned. Now, this is something that I had talked about earlier. Now, I was talking about index funds, and these days, there's a very big battle going on between, should you choose actively managed funds or should you choose passive funds. uh, I'll just present some arguments for and against passive investing. So passive investing was first conceived by Paul Samuelson, where the underlying belief is that collectively it's difficult for market participants to beat the benchmark. So, if I were to talk in an Indian context, it means on an average, the returns that investors make would be equal to the returns the Nifty 50 index gives you in a given year. And this argument makes complete sense. Now, for instance, there's a T20 game going on, or there's a test match going on. Um, so, if the entire team has scored, say, 200 runs, it's highly unlikely that one particular player would have made 150 runs. Uh, so the law of averages are at work here. In a class, if you come to know that the average marks scored by the entire class in an exam is say 50, it's very unlikely that someone would have scored say 100 out of 100 or an 80 out of 100, or at least a large part of the market participants or a large part of the students would have scored marks which is in the vicinity of 50. There might be one or two outliers who would have scored way more than 50, or there might be some outliers who have scored way lower than 50, but a large majority would cling on to the average. And that's what happens in investing as well. There are so many different market participants out there, so collectively most investors would make mean returns, and there are very few investors who would make outsized returns. Now, the issue with actively managed funds is they might, most actively managed funds would make returns that are in the vicinity of average returns, but these funds come with a cost. So essentially after deducting the expenses, so if the average return is 12%, there's a 2% expense that you need to pay. So after paying the charges, you are essentially making just 10% return, and you're actually making below average returns. So that's why people sort of like index funds or passive investing, because the expense ratio on an index fund is extremely low. It's just 0.1% or 0.2%. So the argument is, if an index fund and if an actively managed fund are making same level of returns, then why should investors pay a higher expense ratio for an actively managed fund? And that's actually a very sound argument that people make, and I completely agree on that point. But then in an economy like India, which is just growing, which is sort of a lot of the industries are at an inflection point. It's very easy, or there will always be funds that sort of outperform the Nifty index. So putting 100% of your money in index funds is not advisable in emerging markets. And that's the reason I had mentioned earlier, putting 100% of your money in index funds is not the wisest strategy. So, yeah. Now, basically, investing is all about staying in the game for the longer run. So, typically, what would happen is you might buy a particular stock, and that stock might give you no returns for 2 years or 3 years, and but it would be a very good company. The fundamentals of the company would be very strong. And the example I keep giving is that of ITC. From 2013 to 2022, the stock gave zero returns, but the profits of the company compounded at 9% during this period, somewhere around 8 or 9%. And then today it has sort of doubled from those prices of 200. Now, I want to give you some illustrations of the behavior of a mutual fund manager. Now, this is a fund that I have tracked very closely for the past few months. This is ICICI Prudential Value Discovery Fund. And before I begin this very simple analysis, this is not a recommendation to buy or sell this scheme. This is just an illustration to show how a good fund manager should behave across market cycles. If you buy a particular company and you're confident of its fundamentals, it might be the case that that company might not give you any returns in the first 2 years or 3 years. But if you are a true long term investor, you should not be affected by these short term underperformances. And you should continue holding on investments where you have got high conviction. Now, if you were to look at this particular example of Sun Pharma, now ICICI Prudential Value Discovery Fund is an equity based fund which typically holds around 40 to 50 stocks in their portfolio. Now, in the year 2017, one of their largest holding was in Sun Pharma. Around 6.9% of their portfolio was the 6.9% of the funds were invested in Sun Pharma. Now, what happened was from 2016 to 2017, there were negative returns of around 22. But the fund manager was confident of the company's fundamentals, and the stock was not actually exited because of the negative returns. In fact, the weightage in the portfolio was further increased in 2018 to 10.92%. Now, once again, the returns were negative this year as well. In 2019 as well, the returns were negative. But you can sort of see the returns are negative, but the fund manager has not lost the conviction in this stock. Mr. Naren, Mr. Shankaran Naren, who's the fund manager of this fund, didn't lose conviction in this particular idea. He might have thought, well, I'm confident of the company's fundamentals. The short term underperformance should not deter me. And then from there, what has happened? Post COVID, this stock has given phenomenal returns. And because the fund manager continued holding to this stock, the benefits were reaped. Now someone might come up and ask, it is true that the stock gave phenomenal returns post COVID, but the fund manager was holding the stock even before COVID. But financial markets can never be timed to perfection. It's very difficult for you to predict the exact price or the exact day when a particular stock is going to give you a reversal. Now this is the chart for Sun Pharma. As you can see, I think from 2011 onwards there was a massive rally in all the pharma stocks, and this rally continued till 2015. So the stock sort of peaked out in 2015. And then from 2015 to 2020, so there was this 5 year period where pharma industry had a lot of problems going on, and as a result of which the Sun Pharma stock fell. It nearly halved from the top. Now, from this point, you can see post COVID, as valuations became reasonable, the stock significantly rallied from the lows. And then the stock sort of shot up. Now, ICICI Prudential Value Discovery Fund sort of started buying the stock sometime during this fall, and they kept adding on to the positions as the stock kept falling. Now, this is a trait of a good fund manager. They enter when the stock when the euphoria in the stock is done. They enter when the stock is going through a bad phase, and they keep adding on to their position as the stock falls. And if their conviction or if their investment thesis plays out the way they thought it should have, the stock just rallies massively. And so to reap the benefits of your analysis, you need to hold the stock for a long period of time, and that's what good fund managers actually do. They do not let short term underperformances deter their strategy. So there's something called as the portfolio turnover ratio, which sort of measures what is the percentage of change that is taking place in the portfolio. So a portfolio turnover ratio of 50 is better than a portfolio turnover ratio of 150%. It means that the rate at which the stocks in the portfolio are changing is much lesser is much lesser. And that's what you want to do. You don't want to keep making too many decisions. You don't want to keep changing your portfolio too frequently. Research an idea really well, and the fund manager should hold on to it for long periods of time. Another illustration is with Parag Parikh Flexi Cap Fund. Once again, this is not once again a disclaimer. This is not a recommendation to buy or sell the stock. Uh, this is just an illustration to show you how fund managers behave during market up cycles and down cycles. Now, Parag Parikh FlexiCap Fund sort of started building positions in Persistent, I think somewhere around 2016 or 2017. Now, from 2017 to 2021 or 2020 till COVID, the stock gave no returns. So, for 3 years, the stock gave zero returns. And in fact, during this period, there was a time when the stock went from 569 to 810 and again fell back to 569. So there was a lot of volatility during this period. Uh, there was a lot of volatility. The stock went up and came down, and for a on a 3 year time horizon, the stock gave zero returns. But then the fund manager for this scheme would have thought, I am confident with my analysis, I am confident in my conviction. So this 3 year underperformance should not deter me. And look what happened. Post COVID, the stock went up from 630 all the way till 1900 or 2000. And I think somewhere in 2022 or the second half of 2021, Parag Parikh Flexi Cap Fund completely exited this position after making 3x on their initial investment. So this is an example of right stock picking by the mutual fund manager, holding on to it with conviction and exiting it at the right time. This is how a typical fund manager should behave. Now, I don't want to talk about instances where fund managers have not behaved this way, but there have been instances when fund managers have taken impulsive decisions. They ended up buying stocks that did well in the past, and the returns thereafter were very suboptimal. There have been instances when the fund manager might have bought a stock which might not have given any returns in the first 2 or 3 years, and they would have exited it out of frustration. So these are the traits that you should avoid, and you want to stick to mutual funds and mutual fund houses where they hold on to a given idea for a fairly long period of time, and they buy those companies at reasonable valuations. So to sort of sum it up, whenever you buy a mutual fund, ask yourself these three questions. And I think the moment you have the right answers, or the moment you're able to answer these three questions, it sort of decides what sort of mutual fund schemes you should be buying. Uh, the second part is slightly more difficult for first time investors to practice, but you could sort of let your fund advisor, or you could let your financial advisor uh, decide on these three answers. But then for the fund manager to make an effective for the fund manager or for a financial advisor to give you the right kind of advice, the answer to these three questions should be extremely clear. And the moment you do that, your financial advisor will recommend the right set of products to you. That's pretty much it from this section on on mutual fund investing. I hope that you found this session to be quite useful. If you have any questions, any clarifications, feel free to reach out in the comments, and I'll be more than happy to take them.